Welcome back to Real Estate 101. Today we're going to continue our discussion on mortgage financing and talk a little bit about consolidating your mortgage. And I'm pleased to be joined by Tracey Brock of Dominion Lending Centers. Tracey, welcome to the show.
Thank you, Joe. It's always a pleasure.
All right, Tracey, so I want to start today's show and I want to ask you, what is a mortgage consolidation?
A mortgage consolidation is when you take your credit card, your loan debt, your car payments, and add it to your mortgage, either as in first position or in second position, using the equity existing in your home.
Okay, so what is the most that a lender will allow you to refinance in a mortgage consolidation?
So a conventional lender will allow up to 80% based on the government standards. That would be like any of your bigger banks or other lending institutions. Alternative lenders will go up to 85, even 90%, even 95% on certain circumstances to do a second mortgage.
All right, so what is the main reason that some of your clients, or most people even, should refinance?
There is considerable interest savings to be had on refinancing, even if you're doing it in a second mortgage. Most credit cards are above 12% and a lot are at 29%. So there is a considerable amount of interest that can be saved by getting a second mortgage or reconsolidating your first mortgage.
Okay, and what would you say is the average decrease in payments every month when you do a refinance?
Well, it's hard to speculate that because obviously everybody's situation is a little bit different, but you know, I've seen thousands, like $1,000 difference in monthly expenditures. So if you're
just refinancing?
Just by refinancing, by taking out all the credit card minimum payments. And you have to keep in mind, a lot of the payments that you make on your credit cards, the mandatory payment is just an interest-only payment. So you're paying, if your interest charge in the month is $112, you're only asked to pay $115 or $120. So you're really never paying down that debt. With a mortgage, there is a considerable amount of money that is being put towards the principal each payment.
Okay, so let's use that example. Let's say you do a refinance for someone that saves them $1,000 a month. What do you recommend they do with that extra cash?
Well, you know what? I think the key here is to put yourself back on a budget, because honestly, when expenses come high like that, there's a reason that you've got to that point. So it could be loss of job, it could be reduction of income. So you had to keep in mind that you're lowering your expenses does not necessarily mean that you have extra money to spend. So what you want to do with that extra money is start putting away a portion of your paycheck each month, which will reduce the amount of available cash you have to spend. So let's say 10% each month. You want to make sure that if you have extra money even after that, that you're putting it directly back onto your mortgage because it goes towards the principal.
Okay, so when you refinance, doesn't it extend the amount of time it takes to pay the mortgage down?
In some cases it does, but amortization is very flexible, and every time your term comes up for renewal, you can increase and decrease your amortization. So if you had to increase your amortization to 25 years to maintain what you have to do to consolidate this debt, in 5 years you're in a much better position, and you can then reduce your amortization down to 15 years. So it's all subjective.
All right, so are there any ways to mitigate this extension that it takes to pay down the mortgage? Yep,
you can put that extra $1,000 a month directly onto the principal balance. You can increase the frequency of your payments from monthly to bi-weekly or weekly accelerated. There's lots of other things that you can do to try to make sure that you're budgeting properly and following a budget. It's key.
All right, so are there any cautions to refinancing your first mortgage?
Absolutely. You don't want to get back to where you were. If there was a specific reason that you had to use those credit cards, let's hope that reason has been solved or changed. But if you're just a habitual spender, you want to make sure that you're getting rid of some of those cards. You really only need one credit.
So after you pay them down, close them.
Close them. Close them. Close them. Keep the card that you've had the longest. It looks better on your credit bureau and your scoring. And just keep cards that are used cards for mandatory reasons and not necessarily for extra spending.
Now, is the only reason a homeowner would refinance because of paying credit card or a loan?
Absolutely not. There's some people out there that have some equity in their home and they want to take the equity out to go on a vacation, or they want to take the equity out to invest in a business or another home. So there's other reasons to refinance, and there's good programs out there where you can still keep a portion of your money in a fixed mortgage and have a line of credit associated with your first mortgage. It all comes as one charge, and it gives you accessibility to money that you can use elsewhere.
All right, Tracey, so for today's final question, Does everybody automatically qualify for a refinance if they own a home?
No, not necessarily. There's obviously there's equity, there's income qualifications. The best way for anybody to find out is to call a professional. Call me. I would be happy to spend 5 minutes, talk to you, let you know where you stand, and see what we can do to make a better situation for you and reduce your monthly expenses.
All right, Tracey, I want to thank you for coming on today's show, and I'm looking forward to seeing you again in the new year.
Thank you, Joe.
So if you're thinking about consolidating your mortgage, get in contact with Tracey Brock of Dominion Lending Centers. I'm your host, Joe Terceira. Thanks for watching, and we'll see you next time.